Global economic expansion is likely to slow down to 3.2% this year, is the forecast. And of course, that means it's less than the 3.6 forecast by the International Monetary Fund that they put out in the month of April. And of course, in January, they saw it at 4.4%. So we're seeing that gradual decline. The global agency has revised its outlook, indicating that the downward risks of soaring global inflation, also China's slowdown, the war in Ukraine, all of these factors have now started materializing. The International Monetary Fund has noted that there was a tentative recovery back in 2021, but that was followed by increasingly gloomy developments in the year 2022. So the fund has cut its India growth forecast as well, and it has brought it down to 7.4%. Let's get perspective on all of this from what we are expecting out of the FOMC, what that could mean to the markets, what we're hearing from IMF on the global growth projections, and how much pressure of recession could actually play out on the ground. Let's understand this from Craig Erlam, Senior Market Analyst at Oanda. Great to have you back, Craig. As far as the Fed is concerned, the consensus was a 75 basis point rate hike just a few days ago, but the inflationary pressure, now that's building up in the States. We're talking about the world's largest economy here, and claims for jobless benefits there have risen. They've gone to the highest level in 8 months last week. So many aren't ruling out a 100 basis point rate hike, Craig. So what are you expecting now from the Fed at the end of the FOMC meet, and how will that decision play out on Wall Street? Are you expecting a major meltdown?
Yeah, there's certainly weaknesses appearing within the US economic data. I think the housing data has been particularly weak for many months now, and we're seeing that really come through in the housing data that we're seeing over the course of the last month or so in particular. As you said, the jobless claim still is very low. It did peak higher last week, and that is a bit of a concern, but I think we need to see that develop into more of a broader trend because the data itself can be quite noisy. The retail data, I think, as you've alluded to, is very interesting because for a while now, the retail sales data and the consumer sentiment surveys have not really aligned. We've seen big warnings from the consumer surveys for many months, and that has not translated into weaker retail sales data. But when you add in what Walmart have said this week, then things just don't start to add up. And we are looking at a piece of GDP data later this week that could potentially shockingly confirm that the US is in recession. And that follows President Biden's comments yesterday, which raised a few eyebrows that he wouldn't really consider the US to be in recession anyway. So that's raised a few questions about what we can expect from the data on Thursday. Throw into that what the FOMC has to now deal with, which is the prospect of a recession, warnings from major retailers like Walmart, and economic concerns, and inflation, which is running far too hot. I think a 75 basis point would be the safe option on Thursday. You could make a case for 100 basis points if it wasn't for some of the other more concerning developments that we have seen. I think 75 basis points is the safe option, which then leaves the door open in September to taking a more gradual, considered approach once it has more data to hand.
So while we expect the Fed policy to be announced and how that is going to play out in the markets remains a point of concern. We're seeing the markets jittery even today. But then the other big voice is that of the IMF, the International Monetary Fund, Craig, and they're expecting a knife at the throat situation for the global economy, to put it in her own words. Those central banks, of course, they're going after inflation. The jury is out on how much they can actually control rising prices. Do you think a resilient domestic economy like that of India could help it stave off some of the ill effects of a global recession, the kind the IMF is projecting here?
Well, I think every country has its own challenges right now, and I think we are seeing. And I guess the other thing we have to point out here is the job of central banks is primarily inflation, and that is also the greatest growth risk for these economies for the next decade. So we shouldn't underplay the trade-off between controlling inflation and prioritizing growth now. We need to prioritize controlling inflation, otherwise growth over the longer term is going to be it's going to be a much bigger concern. So I think the central banks have to focus on that. And if they think a recession is coming, which may help to tame inflation, then perhaps that needs to be factored into their forecast. But we should certainly not see any of them taking a step back in fear of potentially causing a recession in the shorter term, which I still think will be relatively mild. But as you say, every country has its own issues, and I think if we do see growth in some of the major economies, then we will obviously see that help to lift others. We saw that, for example, with China after the global financial crisis, when we saw a massive infrastructure spend, which helped to support the economies, for example, of Australia and others, but also helped to support global trade, which of course is extremely important in times like these. So there's many different things that we need to consider right now. The fact that the IMF is lowering its global growth forecast is not a surprise, and I expect we probably will see more of that again over the course of the coming months. And I think that is when we'll see things become a lot clearer, because we'll have a lot better idea of inflation. We'll also have a lot better idea of energy prices and, of course, the war in Ukraine.
Also, before we let you go, Craig, about the currency, a 100 basis point rate hike could strengthen the dollar against its major currencies. The Indian rupee already has become weaker by almost 7% this year. How will a stronger US dollar affect emerging markets like India, in your opinion?
It will have an impact. It always has an impact. I think it will have a lesser impact than it had, say, a decade ago. A decade ago, I think many of these economies were far more vulnerable to a rapidly strengthening dollar. The current account deficits were larger. They have obviously been exacerbated by the movements that we've seen in energy prices right now. And that's potentially one vulnerability for the Indian rupee, is the fact that it is still a massive energy importer. And therefore, the stronger dollar could exacerbate that. I think other countries have a much greater problem, though. You look at a country like Turkey. I mean, they have massive problems even without taking the dollar into consideration. But when you take into consideration the movements in the currency as well, then you've got huge problems with the current account and dollar-denominated debt and other things as well. Other countries are far more vulnerable. I think India is relatively resolute, and I think while the issue around energy imports is a concern when the dollar strengthens, I do think it is among those better positioned to cope with this, though, as are many others, like say compared to a decade ago.
Craig Erlam, thanks very much for joining us from London with your perspective on this. Of course, the US, China, the Euro area, of course, India are all witnessing sharper slowdowns because of extended lockdowns in China, which of course affects trade with China, besides the effects of tightening financial conditions, the steeper interest rate hikes, and of course, sticky inflation. All of that comes into play. But how much this is going to affect markets in the long term, that is also the big question we are trying to ask.